Well, good evening and welcome to this live stream event on the 3rd of November 2020. I'm Martin North from Digital Finance Analytics. Great to have you on board tonight, which I think will be an important show given everything that's happening at the moment. We'll be covering the Reserve Bank announcements today with quantitative easing. We'll look at the latest stress data, and we'll also cover a few other things too on the way through. As normal, we will just start with a few introductory remarks, just in terms of our agenda for tonight. This introduction, of course, the house rules briefly about our models, just so those people for the first time on the show get to understand how we do what we do. Then I'll just cover some key issues quickly, and then we'll move on to questions and answers. The bulk of the show will be answering your questions, and then we'll wrap up and sign off, probably about an hour to an hour and a half, depends a bit on how the discussions go, but certainly we should be finished by about 9:30 Sydney time tonight. And I noticed we had some people from New Zealand. I am going to try and do a show specifically on New Zealand, some we should talk about there as well, but it's just a matter of time and focus, and it's hard to cover everything, but there are some interesting similarities between what's happening on in New Zealand and what's happening in Australia. Now, in terms of the house rules, it's just I want to say this isn't financial advice. I'm not a financial advisor. I'm merely talking about my analysis and my data. If you need financial advice, then go find a qualified financial advisor who can actually get into detail with you and your personal circumstances. I can't do that. Please play nice in the chat room. No racial slurs. The stream is being moderated, of course, and we will turn people off if they get a bit antsy. Also, this is the 3rd of November 2020. If you're watching this in replay, you'll know whether in fact we got it right or not. And if you want to get my attention on the chat, there's always plenty going on. Use @WalkTheWorld. That will make sure that your question goes to my list. However, if you also want to make quite sure that your question gets to the top of the list, I've enabled Super Chat. Super Chat enables me to do two things. One is to see those questions right at the top. And then secondly, if you want to make a contribution to help with what we do here, because essentially there are some costs involved in running DFA and all of the world stuff for you on the channel, then you can contribute like that. Now, quickly on the model, the fact of the matter is we continue to survey households on an ongoing basis, and the thing about that is we have 52,000 households in our survey at any one time. We also pull information from many other sources, including Job Seeker, Job Keeper. All of that goes into our core market model, and that drives everything that we do. That means that what we can do then is to look at it from a data analytics perspective across multiple segments, multiple dimensions, and that allows us to look at it in some detail down to a postcode level. We can also run our scenarios, and that's what we're talking about tonight in terms of how things might progress ahead. And we also look at our house price scenarios using the mortgage stress data, the price trajectory and history data that we've got, the buying and selling intentions data from our surveys, the migration statistics, and the economic data. All of that goes into the core model through our scenarios, and that means at a postcode level, at a region and a state and all Australia level, we can actually then talk about prices and expectations of prices. And later on, I'll show you the latest developments of our postcode tool, because we've been working on that, and we've got some extra functionality now to share with you tonight. Now, in terms of the data, let's start with the RBA decision, because of course that was very, very significant. The RBA said that they had launched a package of further measures to support job creation and recover the Australian economy from the pandemic. What they could have said or should have said was this is a package of measures to support the banks and make sure they've got more liquidity. They went on to say that Australia faces a period of high unemployment, and the Reserve Bank committed to doing what it can to support the creation of jobs. But the recovery, whilst there is some information to show that things might be improving a little, is bumpy and drawn out, and the outlook remains dependent on successful containment of the virus. And that is important to understand. A lot of the predication at the moment on what's going to happen is going to be determined by what happens with the virus. Now, in the elements of the package today, there was a reduction in the cash rate to 0.1%, very small from 0.25%, really hardly noticeable for most people with a mortgage. A reduction in the target for the yield on the 3-year Australian government bond to around 0.1%, so that's keeping rates low again. A reduction in interest rate on new drawings under the Term funding facility to 0.1%. So that's essentially the flow of funds going back into the banking system. So that's going to be even cheaper money for the banks. A reduction in the interest rate on exchange settlement balances to zero. So that's trying to encourage banks holding any money at the Reserve Bank to actually lend it instead. And also the purchase of $100 million of government bonds of maturities around 5 to 10 years over the next 6 months. Now that's very important because what that is doing is essentially trying to control the longer term interest rates. And this is quantitative easing naked now, so there's no denying their quantitative easing. And they also said that the program will allow them to purchase longer dated bonds. The bank will buy bonds issued by the Australian government and by the states, and an expected 20-80% split. Those bonds will be brought on the secondary market through regular auctions, with the first auction this Thursday. So we are in the middle of QE. And they also made the point that they will purchase whatever quantity of bonds is required to achieve the 3-year target. And any bonds purchased to support this target will be in addition to the 100 billion bond purchase program. In fact, if you add this all up, it's more than 300 billion already and rising. But that, by the way, is still relatively small compared with some other countries' central banks' interventions so far. So expect more from the RBA later. Now, in terms of that decision, there were some things that basically came out from the result of that announcement. The first thing they said was that positive GDP is now expected in the September quarter, despite the restrictions in Victoria. But it will take some time to reach the pre-pandemic level of output. That's exactly right. Now, there is, of course, a technical discussion about the fact that when you have a very significant drop and then a small uptick, that's actually positive growth, so you can claim that the recession's finished, despite the fact that your level of growth will be significantly lower than it was before the thing started. And they said in their central scenario, GDP is expected to be around 6% over the year and 4% in 2022. Importantly, the unemployment rate is expected to remain high, but to peak at about 8% or just below, rather than the 10%, so they're not quite as high now on the unemployment as previously. And at the end of 2022, the unemployment rate is now forecast to be around 6%. Previously, it was forecast at 7.5%. So there is a little bit of good news there in terms of the potential impact on GDP and unemployment. Now, they did say that the extended period of high unemployment and excess capacity is expected to result in subdued increases in wages and prices over the coming years. Inflation is forecast at 1% in 2021, 1.5% in 2022, and in the most recent quarter, the year ended CPI was at 0.7%. The underlying was 1.25%. So in other words, well below their target of 2 to 3%. And what this is really signalling to my mind is that this is now going to be not a strategy based on just targeting inflation. It's going to be using other tools. Now, they said that the high rate of unemployment is a national priority to tackle it, and the RBA's response is complementary to the significant steps taken by the Australian government. So they're looking at it holistically with everything else that's going on. And they also said that by lowering the financing costs of borrowers, contributing to lower exchange rates than otherwise, and supporting asset prices and balance sheets, the bond purchases and the low interest rates will drive the outcomes that they desire. And also the term funding facility is contributing to low funding costs and supporting the supply of credit to the economy. Now, they've already drawn, the ADIs have drawn 83 billion from that already, and will have access to a further 104 billion. Now, of course, the question I have is, you can actually flow all of this into the banking system, but if people are unable or unwilling to borrow, there's no demand for it, it's not going to work. And so there is still, in my mind, a big question about the demand side. This is all supply side stuff. What about the demand side? And at the moment, that for me is a big question mark. Now, they said that the board would not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. And that means that they need to see wages growth will be higher than it is currently. It also requires significant gains in employment and a return to a tight labour market. And they said, given that, they expect the cash rate to be at this low level for at least 3 years, and the board will keep the size of the bond purchase programs under review, particularly in light of the evolving outlook for jobs and inflation. The board is prepared to do more if necessary. And that's really, it's echoing what the Fed has said and what the Bank of England has said. They will do whatever it takes. The question is, doing more of the same that they've been doing for the last few years, is it going to have a different outcome? That's a really interesting question for a discussion on another occasion, perhaps. Now, after that, Phil Lowe then actually gave a press conference, and he made some rather important points and made a specific comment about, is the RBA now out of firepower? The short answer, he said, is no. The Reserve Bank is not out of firepower. We have additional monetary policy options and we're prepared to use them if the circumstances require. In terms of interest rates, we've gone as far as it makes sense to do in the current environment. There's no change, they said, to the bank's view that there will be little to be gained by lowering the policy rate into negative territory. So they're still turning the negative rate option off. But of course, Phil Lowe has already said in the past that rates won't drop below 1.5% or 0.75% and 0.1%. So, don't take too much notice of that. I think we'll end up with negative interest rates in the next 1 to 2 years. Monetary policy, he said, is more than just short-term interest rates. It's also about the bond purchases. And given this, they're going to continue to monitor the economic situation and impact of the purchase of market function, and we'll do more if we can. We will. And they also said the point that the Reserve Bank has other tools, including further liquidity provision, asset purchases, and transactions in the foreign exchange market. All of those things, of course, which is what the Reserve Bank of Japan has been doing, or the Central Bank of Japan has been doing for some time. So we're just following the old playbook, the same playbook that the Japanese Central Bank, the European Central Bank, the Federal Reserve has all been doing. We're just late to the party. And you have to ask whether this is actually going to get to where we need to get to. I'm not sure that it will. So, to re-emphasize this once again, he said, we have to underscore that we're not out of firepower. Methinks he doth protest too much. Now, there's a few interesting articles I just want to refer to. Adam Crichton made an interesting article today, and he was talking specifically about the question of what happens next. And monetary policy can't affect anything real in the long term is one of the most interesting quotes. He quoted Warren Hogan, an economist at UTS Business School there, and made the point that this whole idea of targeting inflation is potentially fraught with danger. So not totally supportive. I have to say that he's onto, I think, an important point there. And Canstar came out and made the point that a cash rate cut is unlikely to stimulate the economy. And in fact, I'm going to interview Steve Mickenbecker tomorrow to take this further. But he makes the point that the average mortgage, a cut of 0.15% on a $400,000 over 30 year is $33 a month. It's a cup of coffee a week. It really makes a very little difference. And he makes the point that economic stimulus is more about confidence and jobs. The cuts look like realign the cash rate with what's been happening in the real economy. And he also made the point that 94 lenders have cut the variable home loan rate this year by an average of minus 0.36%. 72 lenders cut fixed rates this year by an average of minus 0.67%. And the lowest variable rate for unoccupiers paying principal interest with an LVR of 80% was 2.74 in January. Now it's come down by 0.55% to 2.19%. The average variable rate has dropped from 3.73 to 3.37. The lowest variable rate in the market is Homestar's Gold Star variable rate at 1.79 for a 60% LVR. That's the lowest rate so far. I expect lower rates ahead. But savings rates, 61 banks have cut savings rates in 2020 with only one increasing savings rates. Bonus saving accounts have been cut by minus 0.63%, while regular savings rates have come down by minus 6%, 0.6%. And the highest saving rate for adult savers is currently 2%, down from 2.65% at the start of the year. So what you can conclude from that is that essentially so far, savers have been hit And, some of those lower rates have been available. But of course, those rates have been available only to new customers. They have to switch to get the new loan rates. And the banks are being quite selective as to who they finance with those lower rates. So I think it's very unlikely that we're going to see that 0.15% flicked across to everybody, because this is more about controlling the yield curve over the longer term and controlling the price of the bonds, basically funding the government debt, borrowing very cheaply, and also providing more liquidity for the banks. That's what it's about. It's not really about the retail end at all. And by the way, the recent results from Westpac and ANZ showed that margins are significantly under compression. And of course, as rates come down, the margin compression situation gets ever worse. Now, just looking at a few other pieces of data, the Roy Morgan confidence data came out and showed that confidence was just up a little bit. There is still this mystery about the Westpac sentiment index, which came out a few weeks ago and showed a massive rebound. It just seems to be out of the money compared with all the other surveys, my surveys and the ANZ Roy Morgan confidence surveys. Sure, confidence may be up a little higher, but it's still very much in negative territory. So to my mind, there isn't a huge amount of insight to be gained from that Westpac data. This is more like what I'm seeing in my own data. So that's where I'm heading with my information sources. And another thing that Roy Morgan came out with was that 70% of working Australians employed have been impacted by COVID-19. Highest in Victoria at 79%. New South Wales at 69%, Tasmania at 68%, Queensland at 65%, WA at 63%, and SA at 58%. And they made the point that that can be things like reduced hours of work, working from home. It reduces perhaps the social distancing measures, means that split shifts are coming through, increasing responsibility, holding business growth, all of those things which are actually impacted a considerable proportion of the population. And that's important because I know that a number of people have been arguing that all of this is now sorted and we're moving into the recovery phase. I don't think that's the case. My own view is we are in the foothills still of the financial crisis, and it's going to get worse before it gets better. The RBA is saying unemployment will be higher ahead. And for all the other reasons, like the reduction in stimulus, I expect it to be considerably worse before it gets better. And this is a point from this survey to show how broad the impact is. And that's one of the reasons why I think my surveys are quite important when it comes to understanding what's going on with, for example, mortgage stress. Now, one other interesting observation we can come to is this information from the ABS. The ABS released data showing a 6,595 drop in people moving to Melbourne in the June quarter. So we are seeing some net migration, and some of that migration from Melbourne is going into Queensland, one of the reasons why we're seeing a bit of interest in Queensland property. And interestingly, the net changes were lower in both New South Wales and Victoria to the benefit of Queensland, so 6,700 people in Queensland. And that is significant, very significant, insofar that it's rebalancing some of the dynamics across the country. And it also explains why we are seeing slightly stronger demand for property in some areas of Queensland, although don't be distracted too much by that, because prices in Queensland are not particularly strong, despite the spruikers. And CoreLogic, of course, said that dwelling prices rose 0.4% in October. It's interesting, just looking across the month, very slight rise in Sydney, a fall in Melbourne, and the strongest rise in places like Brisbane and Perth, Hobart, Darwin, and Canberra. And, of course, the quarterly and annual movements over the quarter down, annually up by 3.9%. Well, we've discussed that yesterday with Edwin in terms of what this may mean. May tell you not all the whole story, possibly. Now, SQN came out with some really more significant information, which is that the listings have increased by 27.45% over the course of October, with 17,000 more properties on the market. And look at this, the strongest monthly change was in Melbourne, with 26% increase in listings, and that's obviously to do with the lockdown coming off, but an 8% rise in Sydney. So those are the two markets, plus Canberra and Hobart, where the listings are the strongest. And what that means is that compared with September at 289,000, we've now got 308,000. Remember what Edwin keeps saying? Even a small increase in listings has a significant impact in the demand-supply equilibrium or disequilibrium, and therefore the risk that prices perhaps will fall rather than rise. So I know there's all this talk about property price rises, but there are some other factors to bear in mind, and this is one of the critical ones in my mind to look at. So it's pretty important to keep watching the listings. And in fact, in my surveys, I'm seeing more evidence of more households thinking that they may well put their property on the market ahead. Now, interestingly, CBA said that they were going to launch a moratorium on forced home sales until September 2021 today. That's the first bank to respond to pressure from the Financial Counselling Australia people. Basically, what this does is it gives the bank longer to deal with those who have yet to commence repayments. And of course, what they're actually doing is putting a lot of pressure on those who are unlikely or unwilling to start making repayments to put their properties on the market in an orderly fashion. And of course, that longer period allows a bit more time to deal with it. Remember that the APRA guidance is that by March next year, all of the forgiving processes must have come to an end. It will be interesting to see whether APRA kicks that on. My own view is they may well do that and give a bit more leeway. But it's interesting that CBA has basically announced that particular moratorium. And just another quick one, the Reserve Bank partners with CBA, National Australia Bank, Perpetual and Consensus on wholesale central bank digital currencies. I can't underscore strongly enough the emergence of central bank digital currencies and how this plays ultimately into monetary policy. Now, at the moment, the Reserve Bank is behind the 8 ball. Many other central banks are also exploring with central bank digital currencies. In fact, I discussed this a few weeks ago with Nuggets News on this channel, if you want to go and look at that. But the fact of the matter is that as you move closer to zero, as you try and force people to spend rather than to save, which is what they're trying to do, because effectively anybody who saves is putting money out of the system. Anybody who's spending is continuing to put money in the system and to basically push money through and around. So the digital platforms of central bank digital currencies could well become a mechanism by which they control more of that and essentially drive it forward. Now, this is a wholesale experiment, and what it's doing is basically looking at devolved ledgers rather than centralized ledgers, more efficient, faster, more secure. But it does continue that journey towards a central bank digital currency. And this is something we need to watch very firmly, because in my view, there will be no holding the Reserve Bank driving ultimately for a digital dollar. And that will then be in direct competition with the likes of Bitcoin and other, blockchain structures that are actually completely devolved. So watch this space, but this is an important departure in my view. And just quickly on the US 10-year bond price, it's going higher. Interestingly, that the 1% rate, of course, it's been below 1% for some time, and it's been rising slowly. Now, some of the bond people are worried about this, thinking that the rate, if it goes higher, could actually begin to break the system. From February to September, the Treasury issued 170 billion US in notes and 259 billion in bonds. Yeah, mere bagatelle. At the same time, the Fed purchased 1.22 trillion in notes and 338 billion in bonds. And if the rate does go higher, you can expect the Fed to intervene once again, to try and keep the rates down. Of course, they're doing precisely the same thing as Phil Lowe is now doing, using bond purchases to try and control the yield curve. And the likelihood is they will go out longer to try and pull the yield curve further down, because none of the central banks can countenance the idea of rates rising. We are in this one-way cul-de-sac where essentially rates have to be lower and lower and lower and lower, and that I can't see necessarily any way back from this. None of the central banks, to my mind, have a plan other than, well, if we do more of the same, only bigger, then we're going to get a different outcome. And, as I've said several times, and I'll say it again, definition of insanity, doing the same thing again and expecting a different outcome. doing it with more and bigger and more frequently doesn't necessarily change the outcome. And in fact, as interest rates come down, what you're actually doing is applying deflationary forces in the economy. And that liquidity, if it's not lent to businesses and households because they can't or won't, then effectively it goes into asset bubbles and asset prices, but it doesn't necessarily go into the real economy. And that is precisely the disconnection that we've got happening in the Eurozone and in Japan at the moment, which is why this whole thing of quantitative easing is not necessarily inflationary. It could well be deflationary. And we'll be picking up and having another conversation or two about that in coming weeks. I've got a couple of guests lined up to explore that further, so that'll be something to watch for later. Now, let me just cover quickly the mortgage stress stuff. So mortgage stress was higher this month. We were at 39 last month. We were at 40.6 this month. And that's a direct impact relating to the job seeker, job keeper windbacks. And so we can see there that the rate went from 39 to 40.6, below the start, before the start of the virus, we were at 32.9%. So we've got pretty much 8% more of people in mortgage stress. Remember how I measure mortgage stress? Mortgage stress is defined in cash flow terms. It's money in, money out. It's not the same as the Roy Morgan system. So Roy Morgan came out and said that the mortgage stress was a lot lower, but they have a completely different definition of mortgage stress. And they tend to use a fixed ratio and then they adjust it slightly. I'm looking at cash flow, money in, money out. How much money is coming into a household, how much money is going out. If they're at or below zero, then essentially they have an issue. Now, they may well be able to put money on credit cards or tap into deposit accounts, but nevertheless, if they've got a cash flow issue, eventually it will catch up with them. So that's how I define it, and that's the latest data. And interestingly, if you look at the household debt from the debt to income ratio from the RBA, it's dropped back slightly. That's partly because people are paying down debt. And it's worth just reflecting on the fact, as I reported yesterday, that there's significant new lending happening. And so the new credit origination is up quite strongly. But total debt is not. Total debt is going sideways because other people are paying down debt. And my own view is that paying down debt in this environment is extremely smart. Now, in terms of the more detailed data, I'll just quickly go through this. So mortgage stress is 40.6% across the whole of Australia. And within that, you can see there that some postcodes and states and territories are more stressed. So Tasmania's got the prize at 50.3% in mortgage stress, followed by 43.5% in Victoria. So Victoria is still in some difficulty. South Australia is a little lower alongside the Northern Territory, and New South Wales at 38.5%, so it's slightly lower. Queensland is 37.6% and is down towards the lower range. Now, in terms of rental stress, so this is, again, looking at cash flow, but for those renting, and there 34.8% of those renting are in difficulty, and that's a significant number. It translates 34.8% to 1.7 million households. And again, you can see that New South Wales has the highest flow at 49.5% of rental stress, followed by Victoria. And then we have the ACT and Queensland. Now, if I go to investor stress, so these are property investors, 25% of property investors are in difficulty. That's on a cash flow basis, or indeed they're trying to sell their property and are unable to sell it, or they've got vacant property. And that translates to 831,000 stressed investors. The highest proportion are in the ACT and New South Wales. There's a smaller proportion being hit in Victoria, Western Australia and Queensland. And then finally, financial stress is my overall aggregated metric. So I take the mortgage, rental and investor stress, aggregate it all, and this is my top level stress figure. So again, it's based on cash flow. And 37.9% of households are in financial stress. That's more than 4 million households across the country. And the highest proportion are in New South Wales and in New South Wales and the ACT. Victoria not far behind. Now, if I look at it by segments, and you can see there each of the categories and what is happening there. Young growing families includes a lot of first-time buyers. 79% of them are in mortgage stress, compared with 57% in financial stress and 38% in rental stress. In terms of the battling urban and disadvantaged fringe, those are those two big cohorts, those living on the outskirts of town in those new estates. Well, 64 and 62% of those are in mortgage stress respectively, and there's also some rental stress there. Interestingly, we also see our multicultural establishment group. So these are first generation migrants to Australia, 36% in mortgage stress, but 50% in rental stress. And I'll also highlight the fact that some older households from a rental stress perspective are in difficulty. And I'd also make the final point that if you look at young affluents, so these are the people who are younger, more wealthy, living perhaps closer into the centre of town. 47% are in rental stress, 17% in mortgage stress, but look at this, 54% are actually investing stress. And that high level of stress aligned to affluence is also showing up in our exclusive professional group, where 49.4% of investors in stress are in exclusive professionals. That's the top end of the market. That's the most affluent households in the country. So it shows you that this stress stuff is not just hitting one or two segments or one or two locations. It's pretty widespread. Now, just quickly, I can take you through the top postcodes. This is mortgage stress. So the postcode with the highest level of mortgage stress is 2170. That includes a number of areas around Liverpool. And interestingly, at 76.2%, that's quite high. The predominant segment is what I call battling urban. Now, just to be clear, that doesn't mean that everybody in that postcode is battling urban, but it basically is the predominant stressed segment in that postcode. The next one is another New South Wales postcode in areas around Lima, Appin, places like that. It's quite a big postcode, that, quite mixed, but 83% there, more than 10,000. And then we go to Narrow Warren, Fountain Gate, and that's in Victoria, of course, at 82.5%. They're young growing families. Another one is Berwick Huckaway at 96.3% at 9,600. Then we go to Toowoomba in the areas around there, up in Queensland, at more than 9,500, 60%. They're in the disadvantaged fringe category, so that is more limited income and more pressure on social and economic factors. And we can go on to Tapping in Western Australia, where we've got significant issues, and then we can go back to Hillside, Sydenham and Delahaye, and then across to another Victorian one, Pakenham Upper, and Ballarat East. So you can see there are quite a few Victorian postcodes in the top list there. If I go on to rental stress, the rental stress capital is Melbourne, Victoria 3000. That's with 12,000 in rental stress, 69.1%. And a lot of them are actually young affluents there. Then we've got battling urban at Liverpool, so 2170 sounds familiar, and then Gosford up in the Central Coast, and then we go to Greystanes and a few others there. So you can see some similarities, but also some differences. Also highlight this, Bondi Beach and Parramatta and Blacktown are all areas where there are high levels of rental stress. And even some more established areas like South Bank, where there are lots of young affluents, or if I go to places like Derrimut, Werribee, Point Cook, that's also another significant hotspot, and I did a show on that one quite recently. If I go to stressed investors, these are property investors, those in Darlinghurst and Surrey Hills. Now, just to be clear, these are where they live, not where they have investment properties. A lot of them are young affluent, more than 4,400 or 79%. Then we go down to Melbourne 3000, so we have a lot of those living close to Melbourne in difficulty. That's the other side of the rental stress. And then we go up to Queensland with places like Service Paradise, as well as then we go across to Mandurah. Funny how Mandurah keeps popping up. A lot of stressed investors in Mandurah, maybe only 32%, but it's large number, more than 4,000. And you can see there that's quite a rich picture in terms of some of the different locations from Wollongong, West Ryde, and so it goes on. And finally, the overall stress, so this is effectively aggregated. The postcode with the highest financial stress is 2170, and that's places like Liverpool. Then we go to 2560, 4350, that's Toowoomba, Melbourne 3000, and then we go to Mount Druitt and places like that, Cranbourne South in Victoria, and on it goes South Wentville, Westmead, Derrimut, Point Cook, Werribee. So those are some of the postcodes with some of the most significant problems. Now, the other way I can show this is just quickly, I've mapped financial stress this time. This is Sydney, and you can see there some of the redder areas where quite a lot of the issues are. But it's worth noting that some of those inner suburban areas, like here, just towards the Bondi and Waverley, are actually also quite severely impacted too. So again, it's important to understand from a financial stress perspective, it's quite widespread, but also quite patchy. And if I go to Brisbane, this is the broader Brisbane one, including the Gold Coast and the Sunshine Coast. Some of the Gold Coast areas are in some difficulty too, but there are a few hotspots. And if you actually then drill down more closely, you can see some of the postcodes there. So 4006 is a postcode, 4504 another one, 4506, where a high proportion, above 74%, are actually in financial stress. If I go to Melbourne, you can see again the hotspots west of the city, around this sort of area here in the city of Wyndham, east of the city down towards the Dandenongs, and also up north, and even if you go to places like Ballarat and such similar places there. So it's again quite widespread, Macedon Ranges. And if you look more closely, close in, you can see 3806, 3805, as well as some of the others there. So again, it's interesting distribution, quite a few hotspots. And if I go across to Adelaide, bit similar story, not quite so severely stressed from a financial stress perspective, but still quite a few going on. And then I go across to Perth, and you can see there north and south of Perth, down towards Rockland and Mandurah, around that sort of area, and north up towards Wanneroo. And if you drill into the centre area of Perth, again, some degrees of stress, not as bad as down the east coast, but still significant issues. WA does seem to be improving somewhat actually at the moment. And then if I go to Tasmania, to Hobart, you can again see some similar positioning. Some stress, not as much as in others, but there is some rising stress here because of the disparity between home prices, rentals, and the overall economic situation. And finally, I'll just drill into Hobart so you can see closer in there, and we'll go up to Darwin just to complete the picture, because everybody complains when I don't cover Darwin as well. So there you go, there's Darwin just for a complete picture. Okay, so just finally, my scenarios, I have updated them, and this is the current state of play. So the RBA baseline is now RBA rate at 0.1%, of course it's come down. Unemployment rate targeted at 6.5% in 2 to 3 years' time. That translates to a mortgage stress of 36%, and home prices between 10 and 15% higher from where they are. And I give that now a 5% probability rather than the 2.5% probability last time. My best case, this is the one that I think is most likely to play out, and this assumes that there will be some form of vaccination and some form of virus control. This is the top end of my scenarios. And in that one, not much has changed other than I've weighted it now at 30% compared to 25%, because we could well be getting a little closer to control of the virus in Australia with the fact that Victoria is now unlocked. My longer term crunch scenario, which is the one that I drive most of my modelling from, is still my main scenario. That's 40% weighting, down from 42.5%. Not much else has changed on that scenario, so I'm still looking at price falls between 10 and 30% on average over 3 years, potentially a bailout of a bank, or at least some form of quantitative easing around it. And of course, QE and fiscal is now there pretty much wherever you look. Now, worst case would be multi-wave disruption. So if the virus came back, if we actually managed to bring it back in through the borders again and we didn't get the control, there's still a significant downside risk, 30 to 45%. That's got a 20% weighting. And there is still this uncontrolled pandemic scenario, which is still very unlikely at 5%. but nevertheless, it's still just worth reflecting on, given the fact that the overall trajectory of the virus in the northern hemisphere is still looking pretty concerning. So there you go, and that's pretty much the story so far with regard to what's going on with my scenarios. I use those scenarios, of course, in all of my analysis, and the question, of course, then becomes what's the consequences and implications of that? And that's what we're going to spend a bit of time discussing now. I'll have a look at the questions in a second and go back over and see the questions that have been asked previously. Got a few things to cover, and also I see a few people have been asking for postcode related queries. Let me just explain my postcode model. Here it is. So this is now the flashy next version, which is actually looks a bit similar to previously, but there are a few things that are different. Firstly, we now have the idea of showing the unit movements and the house price movements over 3 years. And that's a big change, because essentially what that does is it allows us to be more specific about how the dynamics are going to move. I picked up Victoria 3000 here, and there we've got 22,000 households, 3,000 borrowing, 18,000 renting, and we've got 14,000 for rent, 76% in financial stress, and then mortgage stress not too high, rental stress very high at 69%, and property investors at 78% in stress. Now that's all very significant in terms of seeing how it plays through. And so in my three scenarios, in the best case scenario for houses, we're looking at down 5%, a slight improvement, and then a further improvement over 3 years. In the worst case scenario, it's down 20% over 3 years, and my mid case, which is the one I drive all my analysis off, is somewhere in the middle. Now, somebody asked me about Port Douglas, which I'll put in and just show you that. 4877. Port Douglas. Now you can see that we've now got a rather sophisticated drop-down thing that happens, which is pretty cool. And yeah, okay, so this is Port Douglas. So this is basically 3,000 households, of which 683 are borrowing, 1,800 are renting, 1,400 properties for rent, and property investors just under 1,000. Total financial stress, 32%. So that's quite low relative to some of the other ones we've looked at. 25% in mild stress, none in severe stress. Default rates at 4%, that's quite high, and we're certainly seeing some trouble up in there in that area at the moment. 35% in rental stress, 16% in investor stress, so not too bad. And my mid case is basically saying that houses will travel pretty much okay, pretty much line ball over the next year, but then likely to fall about 4 or 5% the following year and stay roughly similar. Units, a bigger fall, down 1.8 and then down to 9.1, and 9.1 the following year is my mid case. And you can see there the red and the blue shows the upper and the lower case. So that's the way the tool works. I will just show you a few other things that we can do with it. So we can now search, for example, the whole of Australia and get the lookup for the whole of Australia, right? And we can also now look at it at a state level. So if I say Victoria State, there you go. So we can now look at it at that level. And there is also going to be a comparison between different postcodes, because that's the other little trick we've got now. We can actually build comparisons, and this is one I built earlier. So if I compared 2,000 with 3,000 with 6,000 and 7,000, so up to 4, you can now see the price changes for each of them. And you can also see the financial stress, the mortgage stress, and the rental stress, and the investor stress by each. So that's how the tool is evolving. It's getting quite close now to something which we'll want to be able to put out. But I just wanted to give you an update. And I'll use this tool a bit later as I answer other questions with regard. And Jason, thank you very much for that. I do appreciate it. All right, so let's come back to some of the questions. Lots of questions. I'll do some more postcodes shortly, but let me just go back and see what other questions we've got going on. Thanks for making the font bigger. Yeah, that's good. Hope it helped. Trying to get feedback. And look, what I'm really interested in now is feedback. What else would you like to see in these sorts of tools? I must tell you that the fact of the matter is that these tools are getting more complicated as we add more functionality in, but it's also getting much richer in terms of its use. So, for example, you can compare one with another and then, look at houses and units. So, we're trying to make it better. Okay, now Cookie Boy said, Roy Morgan will be out with real unemployment rate numbers. It was 12.9% last month. A bit surprised. We'll see how that comes out. I expect it to be quite a lot higher. Remember that the official unemployment rate excludes all the JobKeeper stuff, right? So if you're on JobKeeper, you're not unemployed. That means that we know there's a considerable proportion of the workforce that's artificially out the numbers, on the official numbers. The Roy Morgan one includes them, so that's why it's higher. And I still think we've got, in my surveys, 1/5 of households are either unemployed or underemployed, 1/5, 20%. And that hasn't really moved that much, because what we are seeing is some people coming back to work, but JobKeeper being activated for other businesses even now, as we discussed the other day. So it's definitely not over yet, which is why I keep saying we're in the foothills. We're not in the end of the sort of the cycle of the downturn yet. And even the Reserve Bank keeps saying unemployment will be higher ahead even now. And by the way, the Reserve Bank will come out on Friday with some further data on their saving monetary policy, which will perhaps provide some more information as to what's behind their thinking at the moment. All right, now let's see what else we've got. Other questions? I love some of the comments that are going up there. I just haven't got time to respond to them all. So I'm looking for Walk the World if you want a particular request. Is it best to buy a house before Christmas in Sydney? Will the rate cuts and deregulation lead to a price increase in the new year? That's from Lukey. Interesting question. So we are seeing very divergent patterns in and around Sydney with regard to houses. You said houses, so let's focus on houses. In some of the inner suburban areas where there is a limited supply of houses, we are seeing prices rising, and that will continue. If you come further out and look at places like Liverpool and that sort of area, further out, Parramatta, not many houses, but in some areas, many more houses. In those new estates where there's a building and building and building, the prices for houses are not rising. In fact, they are falling. And same with Ryde and other areas too. So it depends which area you're looking. First point. The second point is there's more stock coming on. We know that from the data that I showed you from SQM. We also know there's more stock coming on from our surveys. There are more people planning to list. And the only question from my mind is, will they list before Christmas or will they list after Christmas? It looks to me as though there'll be significant property coming on to the market after Christmas. And that's an intersection of a few things. More of the JobKeeper, job seeker coming off. The end of the principal and interest holiday repayments by probably March. And the fact that there are some people now thinking it might be best to wait a little bit. I'll also make the point that in some cases, agents are trying to advise people to stage their listings so they don't flood the market in a particular area. Edwin and I discussed that the other night. And so expect to see some migration, but you have to go granular really to look at a particular postcode, get as much granular information as you possibly can. I don't think the rate cuts on their own are going to have a significant impact on credit flows. Credit flows was a little stronger, but we've also been offset by everybody repaying their debt down. So the total credit momentum is still relatively weak. And a good proportion of the people who are taking credit at the moment are off-the-plan purchases of newly constructed. Now, of course, they're the people often in the outer suburban areas. Those high-growth corridors, high development areas. I did a show the other day on Werribee and Point Cook. That's a good example in Melbourne. There are many other areas as well. And the point about that is people are being persuaded, bribed, I would say, to buy into these. You don't know what price you're buying in at, really, because you don't know whether prices will rise or fall. You're committing yourself to a considerable development cycle, which could be actually quite complex, particularly because some construction materials are quite hard to come by at the moment. And generally what's happening is that those price movements up, which is what's happening. Look at Western Australia, $50,000 higher because that's what the amount of the incentives were. It's putting downward pressure on existing property in the immediate area. So my own view is this. If you are thinking of buying a house closer into the city, probably one with a larger plot, with limited numbers of similar properties, then you might see prices rise. If you're buying more of a carbon copy type property in some of these more outer suburban areas, I don't think prices are going anywhere. And I think they're more likely to continue to fall. My stress data will suggest to me that more people will be forced to sell ahead. There is very little inward migration. In fact, net migration is negative, as I showed you earlier on, and even interstate migration is negative. Property investors are definitely not really coming back, despite the fact there was a small uptick in property investors flowing in. A lot of the financing that's going on at the moment is refinancing existing transactions rather than new as well. So again, let's not get on a big bandwagon to say, oh, everything's perfect in terms of price growth and the economy. My own view is there might be a small recovery, but it's not significant, and we've still got many downdrafts ahead, to say nothing of what may happen with regard to the virus, of course. All right, what else have we got? So many questions. Are bank profits in danger with lower rates, says Cookie Boy. Interesting question about that. So we saw that both the ANZ and Westpac took big hits. Now, in Westpac's case, the hits were predominantly to do with their money laundering issues, but of course they also have very considerable margin compression. Both banks were talking about margin compression, but they were also saying that perhaps some of the worst is over. With those cuts now from the Reserve Bank, with the cheap funding coming in from the Reserve Bank, they should be able to manage their margins. But both banks, in fact pretty much all the big banks, are now in cost-cutting mode. So they see very little upside in terms of lending growth. If you look at them closely, they're basically saying it's going to be cost, and that means jobs going. So to my mind, the profitability of the banks here in Australia will be severely stretched over the next 2 or 3 years. I do expect higher levels of bad debts. The provisions that they've made are actually quite significant, particularly so when you think that both of them are now saying they don't think house prices are going to drop as far as they did. Westpac at one stage was saying down 20%, now they're saying, oh, hardly at all. And ANZ is still saying much lower than previously. And of course, CBA went from 30% down to 5% up. So all the banks sort of, throwing a dart and hoping it will stick somewhere. That's one of the reasons why I use scenarios, because I think the only way to get sensible with what's going on is to explore the different things that may happen, because there are so many variables. And those variables include what happens with regard to the virus. It includes also the various stimulus programs and how they get stuck, and all the other issues that we've been touching on today. So generally, I think banks' profitability are going to be somewhat stretched ahead, though. And certainly dividends will be there, but they'll be a lot lower. And many, of course, retirees and many people were looking for the income from the bank dividends to support their lifestyle. They've already seen their term deposit rates get crushed to zero, and now returns from the banks are down. So many households in my surveys, particularly those older households, are seeing their disposable income being completely crushed. Another reason why I'm quite sceptical of this so-called recovery. Okay, another postcode, 4280, I think it was. I didn't quite manage to read it. Hang on. That's one of the interesting things about this chat thing, is it jumps. So I apologise if I've missed something. Let me go back. I was there. Okay, and I was going down the list. Okay, 3134 was the first one I got to, so let's put that one on 3134. Let's use 3134. Ringwood. Yeah. Okay, here's Ringwood. All right, so Ringwood, you can see the map there. 12,900 households, 5,800 borrowing, 4,700 renting, 3,500 properties for rent, 36% in financial stress. So quite low level of stress. Very little mortgage stress, 18%. Defaults at 2%, that's pretty low. Renting at 49%, so that's beginning to get a little serious. And property investors at 40%, so middle of the road sort of postcode. And modelling, my base case, mid case is a fall of 8% over the next year, and a further fall of about 3% the following year, and then a bit of a recovery, down 9% over 3 years. For units, down 15%, then another 3% or 4% down to 19%, and then a bit of a recovery in year 3. So basically, I can't see how home prices in this particular suburb can rise at the moment, and it's a question of how low they go. I've got another one here, 2176. 2176. 2176 is Bosley Park. I can't. It's like 2176. Sorry, 2176. User operator error. Bosley Park. There you go. All right. So in this postcode, New South Wales, of course, 14,246 households, 6,000 borrowing, 4,000 renting, 3,000 properties for rent, and 60% in financial stress. So that's quite high. Anything above 40 starts to worry me a little. Look at this, 73% in mortgage stress, more than 4,000. Default rates at 2%, and rental stress at 73%, property investor stress at 35%. So considerable downward pressure. As a result of that, our modelling is that home prices will fall 8% over the next 12 months for houses, and then another 3%, and a slight recovery at 9.9% over 3 years. And for units, down 13% over the first 12 months, down again to 18%, and a slight recovery to 16% over 3 years. So that's that one. Okay, to Bosley Park, I've done that one, John. Hope that's okay. David wants 3810 at Pakenham. 3810. Oh dear, come on, type 3810. Pakenham, there you go. Consider it done. Okay, very important postcode this. It's a big one, 17,000, nearly 8,000, 18,000 households, 9,800 borrowing, 7,500 renting, 5,600 for rent, and 68% in financial stress, so pretty high. 79% in mortgage stress, that's 7,800. 3% default rates, that's a bit higher than some of the others. 39% in rental stress, 28%. So it's a story about mortgage stress, and that's what I would expect looking at this particular segment. Young growing families, a lot of first-time buyers, a lot of people buying these home and land packages. And so houses down, mid-case 10%, another 2%, and then a 3-year view of 10%. So 10% down over 3 years is my mid case. Worst case would be down 19% over 3 years. My best case would be down just a couple of percent over 3 years. Units significantly fall, 17%, another few percent down, 21%, and then a short recovery to 17%. So that's that one. Okay. 3136. I'll do one more, and I'll look at some other questions. I wish I could type 3136. Yep, and that's 3136. Oh, I'm going for Croydon. I don't know whether that's what you wanted, but that's what you're getting. 3136 Croydon. 18,000 households, 8,000 borrowing, 6,000 renting, 4,000 for rent, and 6,000 property investors, 45% financial stress, 35% mortgage stress, 53% rental stress, 31% investor stress, and house price trajectory down 9.5%, down another 2%, and up to 9.4% over 3 years. Units down 15%, another 4% down, and 15% over 3 years. All right, let me come back. Getting very evolved now, says Exing. Thank you. Yes. And somebody has suggested Ian McFarlane. I've got quite a few suggestions for other people to come on the channel. I actually have a few lined up. It's getting a little bit tough coming up to Christmas to do all the things I want to do in terms of my guests. But, we got a Jim, and we got a couple of other luminaries on quite recently. There are more coming. Watch this space. One in particular I think you'll be quite impressed over, and I'll add some of the other names to the list and see whether we can corral them in later. And Madeline says, love the new tools. Thank you. Very flashy. Yeah, well, my development team has been doing a really, really good job on this. They've been working with me quietly over a few weeks, trying to get this tool better and better and better. And it's getting to the point now where I think it's something which we can really be very proud of. And the fact of the matter is that there's nothing else like it out there. This is a unique perspective that we've got, driven, of course, off our analysis. Your thoughts on AFR spooking of late? Some of their numbers are blatant bullshit, says Cookie Boy. Yeah, I agree. Well, of course, the AFR, the banker's friend, they are wanting to talk the particular line. And I just would make the point that if you think about what the Reserve Bank has done today and what you think about what has been done previously, all of the strategies are fundamentally about supporting the banking system, the increased liquidity, the reduction of rates, the flowing of liquidity into the banks. In fact, Lowe pretty much said that today. This was building financial stability into our banking system. This isn't necessarily helping the real economy. And I keep coming back to, we need to invest in real things and real people. This strategy of putting liquidity back through the banking system works for the banks, doesn't necessarily work for households and businesses. And I still think there are more SMEs going to fail over the next few months simply because of the fact they can't get the support they need. So this is a big deal, I think. And unfortunately, not only the AFR, but a good number of the other mainstream media journals are all spooking the same story. There's been very little critique of this whole cycle. That's why I cited Adam Crichton today, who actually is at least thinking a bit harder about some of these things. So there's an interesting question here. Minduglas saying, would they just switch all accounts to digital dollars in the future without other options being available? Well, here's the thing, right? If you read, there was a recent IMF report that basically said, if you move to a digital central bank digital currency, that gives you an extra set of levers that you can pull. Because you can have things, for example, like a decaying dollar. So basically, if you don't spend that dollar within a certain period of time, the value gets reduced. Right? That can be done digitally. But what they also want to do is to make sure that you are in the system. So that's one of the reasons why the cash ban was so critical, why we argued so strongly for the cash ban to still allow cash to be used for transactions. Of course, the whole question of the cash transaction ban is now on ice at the moment. But the fact of the matter is, if you can take money out of the digital banking system and use it outside it, then they've lost control. So they need control. They need to have the entire financial system under their control to be able to pull the levers that they want. And I have to give you a parallel between that and the plastic card that's been used in some areas relating to government benefits. You have to spend them in certain shops in certain ways. That's just a mirror of what we might be seeing. So yeah, chances are money will be flipped into digital, and then you've only got digital mechanisms to use it. So fine if you can use digital, fine if you can play within the system, but of course it opens the door to things like personal scores, as in China. Suddenly you find that your digital currency has been switched off because you've said something that actually upset somebody. I mean, all of those things are part of the nightmare scenario if you actually follow that logic. Now, my belief is that there is a potential role for a central bank digital currency, but the temptation of those who have the levers to take it too far and to impose more control, I think it's just way too great. So I think it's something we should be very cautious about. And certainly we should be given the option to use it, but not make it mandatory. But as I say, from a monetary policy, they need to make it mandatory if it's going to work. So that's why I think it's going to be quite interesting to see how it plays out. Now, interesting one from Raj. How does the low interest rate affect the price of gold and silver and mining stocks? Very interesting question there. So, the question you got to ask yourself is, these really low interest rates, are they going to be inflationary or deflationary? Because if you believe that we're going to have massive inflation down the tracks, and people refer to the 70s and the 80s as examples of high inflation, then gold and silver become effectively a hedge against that. And there are a whole lot of people out there on the internet basically arguing that you should be holding gold and silver as a hedge against high inflation. And that is certainly one scenario. But there's another scenario that says, well, hang on a moment, all of this money printing, all of this liquidity creation that we've been talking about is flowing into the banks. What if the banks can't find people who want to borrow the money. Then the money doesn't go anywhere. It doesn't actually create the momentum that people expected. And that can be deflationary. And in fact, if people go and paying back debt rather than taking more debt, that's deflationary. And indeed, if the exchange rate doesn't drop back, the Reserve Bank's hoping that their movements will drop their exchange rate, then we've potentially importing inflation as a deflation as well. So in that scenario, gold and silver may not behave as a particularly good hedge, and in fact it could well be that in absolute terms their value degrades. And that's the big debate. I don't know which way it's going to go. My own view is there are more arguments for deflation rather than inflation, looking at Japan and the Eurozone. But of course, now we've got all central banks around the world doing the same stuff. So potentially, we might see an inflationary future. Maybe we'll get deflation and then inflation. But then also begs the question, well, where do you put your money? Do you put it in zero bearing deposit accounts on the principle that at least the banks are still going to be there, 250k deposit guarantee accepted, I suppose, or do you say I need to move out of deposits into market-facing options instead? And I'm going to have more to say about this, not tonight, but in a future show, because I've come to the view that there has to be some alternative options to just holding money in deposits. I've got a lot of money in deposits personally at the moment. But at the moment, with rates so low and with everything that's going along, and with the risk of the inflation deflation dilemma, maybe there are alternative options. So I'll come back to that in a future show, and I hope to make some announcements in the next couple of weeks. What I will say is that the Walk the World brand, which is of course is my channel name, may become a little more important ahead as we go down a particular route that I'll explain in a future show. Somebody's written that, can you wear a Christmas shirt in one of your upcoming Facebook lives? I don't do Facebook at all. I have no connection with Facebook whatsoever. Certainly on YouTube, I might have a different shirt sometime. Very funny. Okay, we're building a lot of foam-filled gentrified apartments going onto the market at the start of 2021. That's very true. There is a lot of construction. In fact, the building approvals is quite strong, right? So a lot of that was high-rise, a lot of that was in Victoria. We're still seeing more construction coming on, despite the fact we have an oversupply, despite the fact that international migration is close to zero, despite the fact that people are moving out from Sydney and Melbourne into other areas. We don't need more property. The myth of undersupply is crazy. Cookie Boy says, oh, Cookie, you're busy this evening. $1 billion plus in cash under people's beds. Yep, well, that's certainly very true. Many people are holding cash either in safety deposit box, maybe not under the bed. That's not really a sensible place possibly to hold it. But we've got a lot of $100 bills missing. I mean, they're out there somewhere, but we don't know quite where. It does seem to be a case. I also think it's another little foible, and that is that there's an assets test for getting the pension. And if you take money out of the banking system and hold it in a safety deposit box in a bank, then you might be able to pass muster on the assets test. I suspect that could be. Don't have any information about that, but that's one of my theories that may possibly be there too. Okay, Samuel says, what's your prediction for the inner city houses of Brisbane compared to country lifestyle 2 to 3 hours from the CBD for long-term first home buyers? Okay, so closer into Brisbane, there is a limited supply of houses. Prices are a little more stable. In fact, let me just put in 4,000 just as an example. I will go to Brisbane here and just show you, this is the sort of the house price scenarios. So I'm looking for prices to be slightly higher over the next year or two for houses close in to the centre of Brisbane, and that is because there's limited supply. There's a certain level of demand at the moment that's out there, and there's also the fact that the locations where those houses are quite attractive when it comes to access to the city, those sorts of things. Now, if you go further out, we are seeing some quite interesting things going on. In some of those outer suburban areas, houses are also now quite in demand. And some of that's interstate demand. But the total price is a lot lower than close in to the centre of town. So what's going to happen is that we're seeing different types of people buying different types of property. And in fact, a number of first-time buyers are being priced out of buying closer into Brisbane because the prices are too high and they're not looking as though they're coming back anywhere soon. So they're forced to go further out and possibly buy a house in, as you say, in a slightly more rural setting. I've done some studies on the Gold Coast and the hinterland and the Sunshine Coast and the hinterland there, and prices are quite a lot cheaper away from the coast. Demand is still quite strong, but there's also a lot of new construction and subdivision, and that's the other thing to highlight. There's a lot of subdivisions going on, particularly in some of those outer areas, and that is putting a lot of interesting dynamics in play and keeping a bit of a cap on home prices. So my view is that prices are going to be probably less strong further out relative to closer in. But I also think that even closer in, prices are not going to be dramatically higher ahead simply because of the broader supply-demand equilibrium that I've been discussing. Madeline says, post the US election, post-JobKeeper seeker in March, taking account of COVID-19, what do you think the banks will do from April 2021 onwards? Well, so the banks will continue to try and write mortgages because that's the only trick they know. They will continue to discount deeply to get business, particularly with lower loan-to-value ratios with a lower risk. They will be more and more unlikely to lend to SMEs. The SME lending story is the big black hole in this whole story. Many businesses are struggling and will continue to struggle, in my view, for quite some time, simply because of the fact they can't get financing. I think the banks will be putting pressure on people to sell their properties if their incomes are under stress long term. They won't want to foreclose. CBA's announcement I mentioned earlier on is a very good example of that. That's what I expect to see more of. And the banks will be pushing people to sell to get out. I also think that their lending standards will get loosened a little. So the responsible lending laws will change, probably March if it goes through Parliament. And that then puts all the acid back on individuals to be honest about their financial position. Many people are accused of not being completely honest. And of course, it's all being put back on the bank. And the bank says, oh, we don't know about that. Responsible lending says we need to check all of these things. Well, they want to take that away. That's going to put a little bit of more pressure on the banks to be able to lend more, but I think it will be limited because the APRA regulations on lending are now stronger than they were, and we're certainly seeing that continuing at the moment. So my own perspective is banks will continue to lend. They won't be able to grow their books very much. People will continue to pay down their loans. We'll still see more SMEs fall over. That's going to raise bad and doubtful debts. The banks have already made more provisions. They will probably have to use some of those provisions over the next 12 to 18 months. And I don't see much recovery in banking over the next 3 to 5 years because in this low interest rate environment, profit is going to be at a premium. And in fact, in Europe, what's happened is that banks have given up lending and they're now taking into more speculative ventures like trading and those sorts of things and derivatives activity and those sorts of things because that is where they can make more money. So I wonder whether we'll see our local banks taking higher levels of risk and more trading to be able to try and turn a profit. So watch for trading income and other funding sources and other revenue sources rather than home lending over the next couple of years. Okay, what else have we got? Tom Tucker, 2257. Let's do another one, shall we? 2257. 2257. Okay, now Kangaroo Valley. No, that can't be right. 2257. Did it? Sorry, I think I missed it again. 2257. Yeah, okay. 2257. Okay, 2257. Here we go. So this is Hardy's Bay, Kilcare. You can see them all there. If I put that on, you can. Booker Bay, Pretty Beach. 14,300 4,300 borrowing, 6,600 renting, 5,000 for rent, and 4,000 rentals. 55% in financial stress, so slightly higher. 3% defaults, 20 to 90% mortgage stress, 84% in rental stress. So rental stress in this area is significant, and I do see that quite a lot in these particular areas where you've got a lot of people in rented accommodation, many with part-time jobs, fragmented jobs, tourist-related jobs, and 46% of stressed investors. So prices overall, houses, mid-case down 7, down another 3 to 8.7 over 3 years, and units down 12%, then down 17 to another 5% down, and then 14.5% over 3 years. So still looking like price falls in my view. Worst case scenario for houses would be down 17% over 3 years, or 29.8% for units. There we go. Okay, what else have we got here? That's interesting questions from Valib Hove. How accurate or reliable are your surveys? Respect your work. Well, that's an interesting question. So, look, I've been running the survey since 2002, 52,000 household surveys a year. That's a 0.5% sample. We do 4,700 a month. They are pretty definitive in the way that they actually are actually executed. They're executed by a survey company over the phone, and certainly we've been able to track back and look at what we said and sort of how it flowed through. So I'm reasonably confident. We also optimize our surveys to check that they actually are in line with the ABS census data, and also that the total loan pools that we have in our modelling when we gross up are in line with the RBA, so we actually can check those off as well. And our surveys are used by a number of financial services companies, both here and overseas, both in terms of, for example, underwriting loans, as well as broader strategy-related questions with regards to the markets. So they are quite well used. This whole approach of making it more accessible to individuals is a relatively new development, and we think it's definitely worth it. And I would say this, but I think it's reasonably accurate and really important. Oh, Cookie Boy, you're back there again. Gee, you're a busy man tonight. Despite CoreLogic showing the daily gains, are finding a lot of properties with prices reduced and big losses from previous sales. Hoping you'll do another the soup to nuts type show. Yeah, we will. And I've accumulated a whole set of data. Cookie, you've sent me some, so thanks for that. Showing this happening. So, it goes back to this fundamental point, right? If you have a high-level model that says, bit up, bit down, within that there will be significant movements. How accurate the information coming in is going to determine the accuracy of those black box reports. We don't know that. What we do know is individual movements of individual properties. And as you say, Cookie, there are a great number of examples where prices are lower than they were in 2016. Edwin showed us one last night. I see plenty too. So we'll do some more shows on that. Of course, the argument is, well, we're cherry picking the ones falling, right? Yeah, and there are some probably rising as well. But then if you trade off the rising ones and the falling ones, different parts of the market, different locations, different averages. So to my mind, I come back to this simple point. Averaging tells you nothing, right? The average for Sydney, the average for Melbourne, ignore it. You need to get granular. You need to go down to at least the postcode level, or better still, property type within the postcode to get granular. And that's what we do. And that then gives you a much better handle. But even then, there is going to be dogs and stars amongst different properties in different locations, and some will be higher, some will be lower. So it's a complex situation. But I agree, we should do another soup to nuts story soon, because it's a really powerful way of making the point. Okay. Thoughts on rural New South Wales as an investment from John. Yeah, there are some interesting areas. So I'm not sure whether you mean up the coast or inland, but we are seeing some pockets where prices are still relatively low compared with other parts of the market, and there's a bit of underlying demand. You need to be cautious, though. There are some areas that really are not performing very well. And, of course, closer to the coast, those with a view, those close to the beach tend to be outperforming. I've done a few examples up and down the coast. I'll probably do more of those. So I think you have to be selective, frankly. This is from RH. Could you comment on the impact on the Australian economy of the rolling lockdowns in Europe, US and elsewhere? Europe, US and elsewhere. Yeah, absolutely. So the key point here is we can control our borders to an extent, and we can bring the local economy back to some semblance of order, but we are a trade-exposed country, right? We have to export, we have to import. International tourism, international students, huge elements in our total economy. They are turned off at the moment. And the question is, of course, with the amount of virus raging in Europe and in the US, we probably won't be open the borders to those particular economies for any time soon. We also know that their economies, because they're actually very much cramped at the moment, the GDP is way down, the UK is looking like another negative GDP quarter, means that they've got less demand for some of the things that we produce. So there's going to be a direct trade effect and an indirect trade effect. But the other question I've got is, if we start opening the borders selectively and we allow a few more people in, can we guarantee that we're not going to have another Victorian type flare-up of the quarantine falling over? Because if we do and we let it back in again, then we have to go through the whole cycle again. Because until such time as either there's a vaccine or it is eradicated, we are going to see more cases coming back. So trying to live with it, trying to use track and trace to be able to actually deal with it is part of the story. But I think there has to be a lot of caution with regard to opening the international borders. I know there's a lot of pressure in business to bring tourism back, and I'm looking at particular postcodes, Gold Coast, Sunshine Coast, very reliant on tourism. But the fact of the matter is, there are so many places where the virus is not controlled. And if you look at the UK, it's an interesting example. The reason the UK started to get the next wave was because they allowed travel to Spain, and a lot of the virus came back from Spain and then came back to the UK. They've checked that from a DNA perspective. So that was an example where effectively they failed to control it at the borders, and then it's flowed back into the UK, and it's a nightmare there. I've got friends and family in the UK, and it's not pretty. So yeah, tough times, I think. One of the reasons why I still run in my scenarios, the scenarios with the virus more active. All right, now 5096 somebody's asked for. Let's see if we can put that in. Running out of time now with all of this chatting. Okay, 5096, there you go. All right, bang that on. There you go. All right, so this is South Australia, 5096, 5,000 households, 2,800 borrowing, 1,700 renting, 1,300 for rent, and rental property owners, 2,100, 25% in financial stress, 90% in mortgage stress, that's pretty low, 2% in default, and 20% in rental stress, 22% investor stress. So that's pretty good. And as a result of that, our mid case is house prices higher by 1.1% next year, down a bit, down 3%, 4%, and then about 4%, so over 3 years, maybe down 4%. The units higher, 1.8%, down a bit, and then up a bit, down 7.9% over 3 years. If you take the worst case, houses down 13% over 3 years, and 23% if you take the best case, up 4.4% over 3 years, or up 7% over 3 years. So there you go, that's that one. Okay. How about 6059? Somebody else says, all right, 6059 it be, 6059. Wish I could type 6059. Yay. Okay. This is Daniela. Western Australia, 10,000 households, 3,900 borrowing, 3,700 renting, 2,900 properties for rent, and 1,700 rental property owners. 38% in financial stress, 2,400 in mild stress, 61%, so mortgage stress is an issue, 4% defaults, 32% in rental stress, and 14% in investor stress. And prices going higher next year, but 1.8% higher in the best case scenario, or a fall of 3.9% if you take my mid case, followed by another small fall and then a slight recovery, but in negative territory, down 7.5% over 3 years. And units, mid case, down 6.4%, down 13.5%, and a slight recovery to 12% down over the next year. But again, if you take my best case, small rise, up 2.6% over 3 years. All right, what else have we got? John K, thank you for that. And Jason, thank you very much. Appreciate your contribution too. Now Mickey says, how does this bin taxes and just print when we want to fix the GDP limit total productivity? Well, look, the issue is GDP worth measuring in the first place, right? My view is no. Is the stimulus going to actually drive GDP the right way? Probably not. Is it going to stoke the debt bomb? Yes, absolutely. Is it going to actually lead to a good outcome? No. So we need a different way of thinking about it, is my perspective. Now, Otto says, given the true state of the economy and the widespread losses in aggregated income and financial stress, ignoring JobKeeper and job deferrals, the fair value of houses has fallen significantly. Yeah, that's true, and will fall further. There is no might. No. Remember this. House prices in Australia are at least 25% valued above where they should be on long-term ratios. So we're sitting in bubble territory at the moment, right? And I know rates are really low, and people say, well, that means it's affordable. It's still bubble territory, and that is going to unwind at some point. So that's a big deal. Adam asks about bail-in. Am I concerned about Australian bank bail-in? I'm concerned about the theoretical possibility of it happening, which is one of the reasons why the show last week was important with Robbie Barwick. If you've not seen that show, I recommend you do that. Still got time to pick up the phone to the senators and basically say, no bail-in, please. Just change the wording and pass that so that effectively deposits are excluded from bail-in. Practically speaking, I think it's very unlikely that bail-in will happen. Particularly now with rates so low, particularly with all the liquidity coming into the banking system. The banks are being propped up left, right and centre. I don't think they'll need to do bail-in anytime soon. Okay, last postcode, 4510 from Tarek. Hi Tarek, how are you? 4510. Whoops. Try that again. 4510. Yes, what I thought I put in. 4510. 4510. Yep. Look up. There you go. Got it. There you go. Queensland postcode. 19,457, of which 6,000 are borrowing, 10,000 are renting, 7,000 have properties for rent, and there are 6,600 property investors. 43% in financial stress. 20% in mortgage stress, 2% default, 49% in rental stress, 35% in investors in difficulty, and trajectory on prices down a bit over the next year, down a bit more, minus 6.7% for houses, and then a slight recovery, so down 6.5% over 3 years, and for units down 3.8, then another 7% down to 10.9, and then slightly further fall, down 11% is my mid case for that particular postcode. And AI says the question is not should I buy, but it's can I afford to buy? Well, a good point there. What I would say about that is remember this. The banks will make you a mortgage offer, but they don't necessarily consider whether you can repay or not. All they're worried about is their security, right? So it's about LVR and those sorts of things. So just because they can lend you the money doesn't mean that you should take that money. You should do your own calculations. You should basically be conservative in terms of your estimates, and also ask the scenario: what if I lose my job? What happens if, for some reason things change? Have you got an exit strategy? Because if you haven't, then you need to be very careful. The banks will protect their interests. The banks will always be thinking about their security, but just because they approve the loan doesn't mean that it's necessarily the right thing to do. All right, that's it. I have come to the end of the show. Now, there are people who've asked for postcodes that I haven't been able to answer. I apologise for that. I just have got way too many requests. But if you want your postcode, you can contact me via the DFA blog. Send me an email via the blog. There's a little app there to do it. And I will come back to you over the next 2 or 3 days with these snapshots that we've got here. There will be a chance quite soon now to get your hands on the tool directly. And the fact of the matter is that once it's up and available, you'll be able to look up yourself. But in the meantime, if you have a postcode you want me to answer, just send me a message on the blog. We'll have the postcode tool up again in the next couple of weeks. And that's pretty much all I want to say about postcodes. I could, of course, spend a lot more time talking about it, but there's a limit, I guess, to how much time we want to spend and should spend on postcodes on a show like this. What I will just come back to quickly is a bit more with regard to more information. If you want more information, go to the DFA blog, digitalfinanceanalytics.com/blog. A lot of information there. You can also use the contact tool to get in touch with me. If you would like to get information, you can get all of the data that I've shown you today. It's available. The stress data in particular is available from the Patreon channel. You can get that for $50 a month plus GST, and just sign up over at Patreon. There's a link there, patreon.com/Digital Finance Analytics. And that information will be sent out to all those who've previously subscribed in about 3 or 4 days' time. And that will include data up to the end of October. So that's how you can get more information. There are other levels of information as well, and that's a way you can support me on an ongoing basis. If you're interested in having a one-on-one conversation about a postcode where I can go into more detail, I'm still running my DFA one-to-one sessions. I can look at home price information, trend data, look at the modelling, all those things that we've touched on tonight, up to an hour, typically 40 to 50 minutes. And to do that, there's a fee, $250 plus GST, payable in advance, and you can contact me via the blog again. Spaces are limited. We're looking about 3 to 5 weeks ahead if you want one of those, but I'm happy to share my detailed insights down at a postcode level. I also make a few shows, of course, where I've actually gone through, for example, Cairns, and I went through Point Cook recently as well. So I'll make some for general consumption, but if you want a one-on-one, that exists. Or you can make a contribution if you'd like to support us directly. We cover our costs of building all the shows from support from the channel, including via PayPal. So if you'd like to make a PayPal contribution, you can do that there. Or indeed, if you can make a contribution via the old Bitcoin as well, which is another as a QR code if you'd like to use that. Not many people have, but I always put it there because people ask me. And then just to say quickly, there is some DFA merch around. If you go to the YouTube channel or direct to Teespring, mugs and things, just if you want to help support, that's another mechanism. And then finally, just to say that next week we're running a show which I've entitled Property Dogs and Property Stars. And Chris Bates, the mortgage broker who got chopped off in his prime halfway through his last show, you may remember that when the NBN fell over, he's coming back. And we're specifically going to explore what makes a property dog, what makes a property star, and to deal with the age-old question of can you convert a dog to a star, and can a star become a dog? So that hopefully will be a really interesting discussion and very relevant given the thing that's going on at the moment with the markets and everything else. So that's next Tuesday, the 10th of November at 8 p.m. Sydney. I'll look forward to seeing you there. And that's pretty much it. So I want to say thank you very much for spending some of your time here this evening with me. I have appreciated the chance to discuss all these issues with you. I appreciate all the questions. I hope that I've covered pretty much all of the comments. I acknowledge Ron and Lewis for their contributions, and Thaj one as well. Thank you very much for that. And Cookie Boy, thank you very much. Interest earned from the Cookie Boy Bank, the new norm. I love it. Thank you very much. So I wish you all the best for this evening. Keep safe, and I'll look forward to catching up with you next time for another show. We had nearly 700 on the peak concurrent. That's pretty good. And I want to say thank you to all of you spending some time. Thanks for those who made specific contributions. Thanks for your comments. Reach me via the blog if you want postcode information, and I look forward to seeing you next time. This is Martin North from Digital Finance Analytics signing off. See you next time.